All right, in this segment, we're going to talk about investment projects with uncertain cash flows. Basically, we're just going to learn how to use the top row of our calculator for time value of money calculations. So it says, assume that all the cash flows related to an investment in a supertanker have been estimated except for its salvage value in 20 years. Using a discount rate of 12%, management's determined the net present value of all the cash flows, except for the salvage value, is negative $1.04 million. How much would the salvage value need to be to make the investment attractive? Well, from our discussion of net present value, we know that the net present value has to be 0 or greater in order to make the investment attractive. That means in this case that the present value of that salvage value has to be a positive $1.04 million. So when we combine it with the negative $1.04 million, we'll get to 0, which is the minimum needed to make the investment attractive. So how are we going to do it? Well, what we're going to do is use the top row of our calculator and define the variables. So our PV is going to be the negative 1040000. The N is going to be the number of periods, which is 20. I is 12. And then payment is 0 because there's no payments every period. We want to know what the salvage value has to be. And the salvage value isn't received every period, but at the end of the investment's life, which is in the future. So using the top row of our calculator, we can solve for this problem. So we hit down clear to clear it out. Put in the 1040000 as a negative and put it in as our PV using the top row of our calculator. 20 is our N, 12 is our I, and then our payment is 0, and then the button you want to solve for is the one you want to hit last, which is future value. So that tells me that the salvage value has to be at least 10,032,115 in order 145, excuse me, in order for this to be financially attractive. So there's the answer, 10,032,145, because that's the amount that's going to make the net present value of this 0 and therefore acceptable. Let's look at another example to see if you can do it. Bay Architects is considering a drafting machine that would cost $100,000, last 4 years, and provide annual cash savings of $10,000 and considerable intangible benefits each year. How large in cash terms would the intangible benefits have to be per year to justify investing in the machine at a discount rate of 14%? So this one's a little different, but we will use the top row of our calculator. So give it a pause and try it out and see if you can get the answer. All right, I hope you gave it a try. So the drafting machine costs $100,000 and it lasts for 4 years. It provides annual cash savings of $10,000 and considerable intangible benefits. Well, in order for this to be feasible, we need the net present value to be 0. So using our top row of our calculator, N is going to be 4, I is going to be 14. The PV I'm going to use is going to be negative 100,000, the cost of the investment. I'm going to ignore the 10,000 cash savings right now, and I'm going to solve for PMT, which are the intangible benefits I need to get annually in order for this to be feasible. FV is 0 because it doesn't mention anything about a salvage value. So if I plug that into my calculator, N is 4, I is 14, PV is 100,000 negative, payment, I don't know, FV is 0. So if I solve for payment, I get 34,320. So my payment needs to be annually, 34,320. And because I'm already getting 10,000 in cash savings each year, I could take away 10,000. So then that means the additional benefit has to be 24,320. So that one was a little trickier because it also had that 10,000 annual cash savings I already knew about, and I had to solve for the additional savings I would need each period. Because we're looking for the benefits each period, I'm solving for payment as opposed to future value, which would be at the end of the investment. And the way I solved it is I figured out what those annual benefits would have to be every year, which is $34,320. And because I already knew about the 10 I was getting in cash savings, the difference is the additional benefits I would need to derive in order to make this a feasible opportunity. Now we're going to talk about how we would rank our investments in order of preference. So remember, there's screening decisions which determine whether or not an investment is acceptable, and then there's preference decisions where we have to choose between alternatives. So with IRR, it's easy. When we're choosing between alternatives, we choose the investment that has the higher internal rate of return. So it's very easy to rank investments using IRR. But with NPV, it's not as easy, because NPV, you can't just simply pick the one with the highest NPV unless the initial investments are equal. In one of our previous segments, we kind of talked about that, how even though one investment had, it was like the car washes, I think, one investment had an NPV higher than the other, they both had a similar IRR, and that was because keeping the old car wash equipment required a smaller initial investment. So even though it had the lower NPV, the IRRs were similar. So we can't simply compare the NPV between two investments and decide one is better over the other. We have to put them on an equal framework, basically normalizing them for the amount of the initial investment. So to do that, we calculate what's called the Project Profitability Index, which is simply the net present value divided by the investment required. So if we have two projects, A and B, and they both have the same net present value, you may think that they're equally beneficial for the company. But project A requires an initial investment of $10,000, whereas B only requires an initial investment of $5,000. And because of that, project B is actually preferable. The profitability index will account for that size of the initial investment and then allow us to compare two opportunities with different initial investments. The higher the profitability index, the more preferable the investment opportunity.